Hello there, welcome to another live webinar with us from Phillip Nova. And who do we have in the studio today is none other than professional trader Daniel Lang. And what is he going to walk us through? He's going to be walking us through the impact of the Fed's rate tightening on currencies. And what will today's webinar entail? Let me tell you. Daniel Lang will tell us more about the Fed's rate tightening and highlight some potential opportunities that you may want to keep a close watch on. And Daniel will walk us through this through fundamental and technical outlook as well. Touching on the fundamental aspect, he'll be talking about the runaway inflation, the Fed's rate hike, global capital inflow into the US, European bond yield divergence, the impact of the Russo-Ukraine war, ECB's belated reaction, and Bank of Japan in denial, yield cap on Japan government bonds, the euro-yen collapse. And on the technical outlook, Daniel will provide us the technical outlook for the CME Micro FX currency futures. Daniel, if you're all set to go, I can hand the reins over to you. Daniel, are you there?
Yes, I'm here. Thank you very much, Rui.
Hey, Daniel, I can hear you loud and clear. So if you are all set to go, you can walk us through this webinar right now. Members of the audience, at any point in time, if you have questions, please type them into the question box and we'll pick them up for Daniel to address later on in the webinar, in the Q&A segment. All right, Daniel, if you're all set to go, over to you.
Right, thank you very much, and a warm welcome to all of you to spend some time with me this evening. To say that the world, when I say the world, we're talking about not only the physical world, we talk about the financial world, we talk about the geopolitics. We are definitely living in extraordinary times, and in my all 37 years of trading, I have yet to see things having gone so bad, and we are not looking even at the bottom as yet. Things are likely to progressively get worse going forward, and for the remaining balance of the year, and maybe even all the way until the end of 2023, we're definitely going to see a lot more volatility in financial markets. Key among them, of course, the key word here is inflation. We have been exposed to inflation for the past, 6 months or so, and it's likely to get a lot worse before it gets better. Now, before we get any further, let me reiterate that this presentation is by no means an offer to buy or sell any kind of securities, definitely not options and futures, which are leveraged products. And to understand the risk involved in trading any kind of leveraged products, because they do involve margin and they do carry risk of loss. So before you embark on trading any kind of leveraged products, do be aware that the risk is substantial. Likewise, the reward can be equally significant. Okay, so before you get into this, make sure you'll be aware of your own risk tolerance. And of course, there will be a segment in which I'll be sharing with you my views of the various markets, in particularly currencies. And for this session, we will only be focused on currency. Of course, everything that involves financial markets are all interrelated, and what move currency market will inevitably also move other financial markets and asset classes. So like I said, we're going to stay focused only on the impact on currencies. Now, we all know about inflation, and inflation has been with us for quite some time now. If you remember back in January of last year, when President Biden was sworn in to be the president of the United States, the first few things that he did was quite significant. Okay, first of all, he actually canceled the Keystone XL pipeline, which supplies gas and crude oil from Canada to the United States. Now, of course, the United States have their own oil production, but they still import a lot of energy products from Canada. So during the campaign leading to Biden eventually winning the election back in 2020, we can see that the key pillar of Biden's message to the voters was that I will go green. That means to say he is going for the Green New Deal. Means to say they want to cut down carbon emission, and that means to actually eliminate fossil fuel. So that was one of his first act in the first few days of his presidency, was to actually cancel off this pipeline. And now, looking back 1.5 years later, we saw that this decision of his has actually exacerbated the inflation that we are seeing, because from energy independence, now the US has to import energy products. Okay, so that is one. The other one is, of course, is in response to the COVID-19, he actually signed into law what we call the Rescue American Plan, and that plan is basically a handout of $1.9 trillion to every Americans. Americans will get checks mailed into their mailboxes, and basically asking them to go out and spend. And why is it important? Because we all understand, like, what's going to happen later on this evening. This evening, we're going to be witnessing the release of the retail sales number coming in for the month of August. Okay, and retail sales has always been key, because US economy is made up of consumerism. If the US consumer don't spend, the GDP will shrink. Okay, so it is very important that the consumers in America continue to spend. Okay, so that led to the Rescue American Plan to the tune of $1.9 trillion. It's an amount that we have not heard of, and probably you would have trouble getting your mind around the kind of number. 1 trillion is 12 zero. 1.9 trillion is as good as almost 2 trillion. And that is the one that caused the inflation that we are seeing. Because, of course, the Federal Reserve have actually tried quantitative easing back at the start of 2009, okay? Because that was what we call to pump liquidity into the marketplace. But the amount of quantitative easing done by the Federal Reserve did not look into the real economy, because it's just numbers that's been parked with the Federal Reserve. The banks can access those money, and then they repark it back into the Federal Reserve. Basically, it stays within a very closed circuit. But when Biden actually launched the Save American Plan, basically sending checks out to Americans, asking them to spend, that money actually leaks into the real economy that causes the inflation that we are seeing. Made worse, of course, by the subsequent war in Ukraine that we saw in February or 24th of this year. Okay, so it is already a problem, and then when the war in Ukraine started, it added more to the existing problem. Now the entire inflation situation is on fire. Okay, and central banks are tasked to put a lid on this fire. Obviously, we know the Federal Reserve only have one tool. That tool is interest rate manipulation. Going into 2021, we already know interest rate was at rock bottom, as close as you can get to zero. The Fed fund rate was 0.002. Okay, so it was almost zero. So when interest rate is at zero, the Federal Reserve will have no tools, okay, to stimulate the economy, because interest rate is very so low. The only way is up. Okay, so when the inflation situation, at first they actually were trying to deny that there's inflation. Remember the famous word being quoted by the Federal Reserve Chairman Powell was saying that inflation is transitory. That has come back to haunt him, because in March of this year, we're beginning to see inflation getting out of control, and it has gone on to something like 9.1% for the month of June. That is serious, because the way the CPI number is calculated is very different from the numbers that we saw back in the 1980s. Now, the last hyperinflation, I won't say hyperinflation, it was a runaway inflation the United States actually witnessed was during the first oil and the second oil shock, where Saudi Arabia and OPEC actually restrict the supply of oil, okay? So that caused inflation. During those days, the computation of inflation is very different from the current model that's been used. They have actually massaged it in such a way that the real rate of inflation, if we use back the 1980s formulation of calculating CPI, we are easily looking at 17–18%, okay? So in order not to alarm the public, we have been told that inflation as the highest this year for the month of June was 9.1%. Obviously, over the last 2 months, we have seen inflation has actually declined 9.1 to 8.5 and the last number was 8.3, which is actually good. But we got to understand this decline in inflation is brought about by declining oil prices because the global economy obviously is slowing down. So less demand, definitely oil prices will have to come off. But then again, this is just temporary because don't forget we have an ongoing war that doesn't look like it's going to end anytime soon, and it can seriously get out of hand over the next few months. Okay, because we are seeing talks and posture by both Ukraine and of course the backers in the West, led by the United States, has been fueling the war that's ongoing in Ukraine. And Russia is not about to back out and say they're going to withdraw. Okay, so both sides has taken a very hardline position. So if this continues, later on, of course, we will share the latest happening as far as Russia's supply of energy into Western Europe is concerned and why this is important. Okay, so from this chart here, you can see the US current inflation, okay, is back down to 8.3. Now, 8.3%, it is still very, very high. UK also have come down in terms of the CPI. Yesterday, the number reported was 9.9% from a high of 10.1%. This is exceedingly high. Okay, Eurozone, it means the whole of Eurozone in terms of the 27 countries that make up Eurozone is experiencing an average of 9.1%. Okay, and this is just an average. If you compare the Baltic state and the rest of the Eurozone, you can find that the inflation is actually varied. Baltic states is actually experiencing fantastically high inflation rate. Okay, Poland is at something like 40%. Okay, so you can see that Estonia in the Baltic itself are all experiencing elevated inflation, but on the average it's 9.1. Okay, Canada is 7.6, Australia is 6.1. All these numbers is telling us we global economy is a multi-decade high. Okay, in Australia it's 30 years high, in Canada it's 40 years high. Even Japan at 2.6 may seems like a very low, but you must understand Japan have never seen inflation like this nature, okay, for the last 40-50 years. Okay, so we are seeing a global phenomenon. Inflation is here to stay. Now the latest number coming in from the US, like I said earlier on, for the month of June was 9.1%, and it has eased back to 8.3% just last week. And we can see that this curve is telling us, a lot of analysts and say, oh, this is peak inflation, meaning inflation is likely to have peaked, and therefore the Federal Reserve will have less incentive to continue to hike rates as aggressively as it did. Okay, so that led to the immediately after the CPI numbers was released, okay, the market actually was quite volatile. There were equities, and that also spilled on to the currency itself. Okay, then later on we go through some charts and then we show you exactly what happened when the CPI numbers were released. Okay, then what is the attitude of the Federal Reserve? We can see that the Federal Reserve chairman, coming out from the Jackson Hole symposium that they had last month, came out and said that their first focus right now is to tackle inflation with all that they had. So it means even at the risk of sacrificing the economy. Okay, so this is pivotal. Meaning to say that they are going to increase interest rate to the point whereby they can actually see tangible results that inflation is coming down. Okay, and if the number doesn't come down, they will continue to high interest rate aggressively. Okay, so we all know that next week, next Wednesday at 2 a.m. our time, the Federal Reserve is going to have their FOMC meeting for the month of September, and analysts are now worried that the Federal Reserve is going to go for 0.75% increase in interest rate. And there are some analysts that say that maybe the Federal Reserve will take out the bazooka and say, let's do 1%. Now, if the market, if they actually do 1%, stock market is going to crash, the dollar is going to fly. Okay, so market is already conditioned for a 75 basis point rate hike come next week. If the number come out to be even more, then of course everything else will move, including currencies. So it's very important to keep our eyes on the number itself. Okay, and it's not too far. Okay, and then of course the other segment of his statement was saying that even if labor market have to suffer an unemployment rate of 4.1% to 4.3%, where is it right now? Right now it's 3.7. Previously it was very steady at 3.5%. Okay, so last at the beginning of this month itself, we can see that unemployment rate has actually crept up to 3.7. So it is definitely have an impact on the employment, and definitely this will also show up in the GDP numbers. Okay, Q2 GDP has also shrunk compared to the Q1 GDP. So basically, we already have 2 quarters in which the GDP itself has actually come off. So that will impact the GDP negatively going forward. So they are mentioning 4.1, 4.3%. So this is definitely looking at additional rate hike coming. Okay, and all central banks are towing the same line. Okay, even the IMF is coming out and said that we all got to be very stubborn in trying to control inflation, and that means we got to stay the pathway of higher interest rates. So this is already a given. Now this is the current interest rates. Obviously, this is the green dot where we are right now, 2.5, and are they going to bring it up to 3.25? 3.25 is very far away from where they need to be, because inflation is running at 8.3%. So if you're going to match inflation rate, we're definitely going to see a few more very aggressive rate hikes. Okay, we are nowhere near enough to control inflation at the current rate of even at 3.25. So going forward next week, for all we know, if the Federal Reserve hike 75 basis points, we are looking at 3.25 going forward, and this is decidedly very, very high relative to the other central bank rates. Now, when you look at the curve, the Federal Reserve was actually behind the curve. There are countries and central banks that were already hiking interest rate in anticipation that at the low, ultra low interest rate, it is impossible to tame inflation. UK was one of the first. The Bank of England was one of the very first. They actually started rate hike a week before Christmas last year, and so is South Korea. So basically, there are central banks that already foresee inflation to be a real problem. They have started hiking, but the Federal Reserve did not move until March of this year, and you can see that they have been hiking interest rate very aggressively. The last was, of course, a hike of 0.75%, and of course, August itself, there was no FOMC, so they took a break. So that's why there has a plateau at 2.5%. But going into this month itself, as early as next week, we're likely to see another 0.75% increase in interest rate. So this is anticipated. What if it's 3.5? Like I say, all markets is going to move, especially currencies. Okay. Now the dollar has been climbing. What caused the dollar to go up? Of course, there are many factors that cause exchange rate to move, but the dollar has been, we all know, the dominant currencies. Okay, so when you have the Federal Reserve very aggressively has been telepathing to us that they're going to continue to hike rates, what will investors do? What will fund managers do? What will money manager do? They will definitely want to park their money in a rising currency. Okay, so what we are seeing right now is across the globe, when central banks in the States started to hike interest rate as aggressive as it did over the last few months, we are seeing a worldwide capital flight into the dollar. Okay, when we compare interest rates, essentially the bond yields, we take, let's say, for example, the 10-year bonds. The US 10-year bonds relative to another country 10-year bond, let's say we compare, let's say, to Eurozone, for example. Okay, that will cause the money manager to shift their money from euro into the dollar. Likewise, it's also happening in the Japanese yen moving into the dollar itself, because interest rate disparity is getting wider and wider and wider. Okay, it's only logical that most of the money will be sucked into the US dollars because they are paying higher yield. On top of that, exchange rate will be further in their favor if they park the money into dollar right now. We don't have to see very just across the Eurozone and Japan. It's across the emerging markets as well. Okay, Sri Lanka already know that they are already a victim of higher interest rates caused by the Federal Reserve rate hikes, and more emerging markets will also go the way of Sri Lanka. Okay, every time the US Federal Reserve hike rates, emerging markets collapses because simply cannot service their external debt. Okay, so this is one of the main factors. This inflation that we are seeing has got nothing to do with demand. So by hiking interest rate as aggressive as they had, okay, I'm not so sure this will tackle the problem, because this inflation that we are seeing was first caused by the US-China trade war, followed by the lockdown during the pandemic, in which global supply chain has been disrupted or been torn apart. And then when Biden came in, he doubled down on that anti-globalization move by Donald Trump, okay, especially against China. So that stresses the supply chain even further. And of course, the cake is the war in Ukraine, okay. When the war in Ukraine happened, the biggest move happens to be in the crude oil market, because Russia may not be the largest energy exporter, but they are a significant player, okay. So when the US and the West immediately sanctioned Russia's energy export, it caused crude oil prices to spike to as high as $135 per barrel. So yes, crude oil prices has come off of late, but the trend is very, very clear. You can see that from this, insert the chart here, you can see that crude oil prices has been on up and up. What we are seeing from the high $135 per barrel is basically a technical retracement. This market is geared for higher prices. How high can it go? I am not surprised. I will not be surprised if next year we see $200 barrels, $200 per barrel crude oil, okay? Because the geopolitics is just so toxic, okay? The hatred between the West and Russia is so ingrained that definitely both sides are so have hardened their position. No one is going to compromise, and at this point in time, there's simply no peacemaker. Okay, when there is no somebody or an institution that come in between to broker for peace, this thing is just going to continue to escalate. So the war in Ukraine has impacted the energy prices, which feed into the inflation that we are seeing. And not just energy per se, we are also looking at the food prices also have escalated. This is a fact. Everybody can feel the impact of higher food prices. Whether you go to the supermarket or you go down to the hawker center, you'll find that everything costs more in terms of food, okay? And it will get worse because this year we have the perfect storm, okay? We also have drought in the northern hemisphere, okay? Across all the entire northern hemisphere, whether it's in the States or whether it's in Europe or whether it's in China, we are seeing drought, which will eventually cause a reduction in food production, okay? Which eventually will feed into higher prices. So inflation is going to get worse, okay? By hiking interest rate, they not only did not tackle the root cause, I think it's going to make our life even more miserable, because when they make the cost of capital more expensive, everybody suffers, okay? So definitely, we definitely will have to key ourselves for a lot more tough time ahead, okay? Today marks the 204th day in the war in Ukraine, 6 months, and they are still fighting. So for the next 6 months, I think it will still be the same story. In Eurozone itself, you can see that this is what we call the Harmonized Index of Consumer Prices. Entire Euro area have 27 members, okay? They make up the European Union, okay? And you can see inflation on the average is at 9.1%. So this curve is going up despite lower energy prices. So when they sanction, the West sanctioned Russian energy export, the one that bearing the brunt of this is actually the Eurozone, because they are so dependent on the very cost-effective natural gas being piped in from Russia, okay? So when they stop buying, Russia retaliate by first insisting that unfriendly nation that have sanctioned against them will have to pay in ruble for their energy. And then if you do not have enough ruble, because ruble, dollar, ruble, euro ruble exchange rate is a very thin market. There is simply not enough ruble in the market. Okay, so basically you can see ruble are in high demand, and ruble right now is one of the best performing currency this year. Okay, so on top of that, now they say the European Union saying, I want to impose a price cap on energy products sold by Russia. Russia said, look, this is a seller's market. I dictate the price. So Russia said, if you want to do that, I'm not going to sell you any energy products. So going into winter, which is only a couple of months from now, we are now already in spring, okay? We are going to autumn, and winter is not that far away. And if they do not get energy from Russia, it's definitely going to be a very miserable time for the European Union. So energy prices is highly unlikely to come down. Yes, it has come down quite a fair bit from where it was, but it is likely to go back up again. Okay, so you can see inflation not only in energy prices, food will be another weapon that the Russian will actually use. Okay, eventually. So what did the European Central Bank do? They have also hidden their head in the sand. They are even worse than the Federal Reserve. At least the Federal Reserve realized as early as March of this year that they can no longer not act. So they started to hike interest rate from March onwards. So for the last 5 months, you can see interest rate has been going up leaps and bounds. And European Union, they cannot afford to hike interest rate because the external debt of the European Union is actually very high. Now, remember, if you can remember back in 2008, 2009, during the global financial crisis, the then president of the ECB was a guy called Mario Draghi. He said he would do whatever it takes, okay, to stabilize the European Union, and that means employing unconventional monetary policy. He bring down interest rate down to 0, and then he launched QE, unlimited QE. So when they launch QE, they are the only banks that are buying up not only the highly graded government bonds, starting from Germany bonds all the way to the other members of the union government bonds. Once they run out of those quality securities, they started to buy corporate bonds. And even that also run out, they started to buy junk bonds. So big were then as a buyer of the European bond market, they account about 40% of all securities being sold. Okay, so when they want to stop buying, the market will go into a spasm, because when you are a big buyer of all treasuries, okay, whether it's government, corporates, or even junk bonds, then who is going to play that role of a buyer? So the ECB has been very reluctant to hike interest rate because they can't afford it, okay, because they pinned themselves to the corner. So now they have to do that, because if they can see over the last few months, a lot of capital has been fleeing Europe for the United States. And that can be seen by the euro versus the dollar rate. The euro has been falling and falling and falling. Lately, it has again gone back to parity, went below parity, bounced back up above parity, but you know, this is not even the low. If you take a look at the chart later on, you'll realize the low is very far away as far as the euro versus the dollar is concerned. So when you see the euro versus the dollar has been coming down the way it did, it means capital is fleeing Europe for the United States. Okay, so the interest rate differential between Europe and US is one of the biggest bear hug. So they have to close the gap. How to close the gap? They will have to high interest rates. They don't like it, but they have to do it. But this will have consequences in the months and years ahead. Okay. Now, so this is where we are right now. And last week, they actually raised interest rate to match the Federal Reserve 75 basis point. They have never done anything as aggressive as 75 basis point rate hike before. But this is extraordinary time, and it calls for extraordinary efforts. Okay. This is the difference between the euro and US 10-year bond yield. Okay. The one in dark, the dark line is of course referring to the US 10-year Treasury bond yields, and the one in orange is the Eurozone. You can see that the gap remains almost a 1% difference. So long as there is a difference between the two, money will continue to flee to the one that capture the higher rates. Okay, so this is going to be something that we all have to realize. When we look at non-risky assets, when the market is uncertain, when it's become very unstable, you want to park your money in something that has lower risk, means you want to go risk off. And one of the biggest instruments for that is, of course, Treasury. Okay, and when you have bond yields that are not uniform, people will arbitrage between the two. Okay, the one that is higher will definitely will attract more buyer. The one that is lower will come under attack. Okay, so this is, they are trying to close the gap as much as possible, but they can't overdo it because the ECB do not have the stamina and the means to do as to match the US bond yield rates. They simply cannot. So it will continue to suffer as far as euro versus the dollar is concerned. Okay, and this came in last week. For all that we know, Russia now is weaponizing the energy. They know that Western Europe needs energy. Okay, And the whole idea is to make sure that Western Europe actually decouple themselves from the US and actually sue for peace with Russia. Okay, so Russia is doing that knowing that winter is just months ahead. And if they do not do it, if they do not sue for peace, Russia is definitely going to step up the pressure. Now they say they're going to not supply them natural gas, okay, through the Nord Stream 1. They have already canceled off Nord Stream 2 by not commissioning it. They spent billions of dollars building it, but under pressure from the US, they are not allowed to use that pipeline. That pipeline would actually alleviate the problem, because Russia now is giving the excuse that they say the pipeline, this Nord Stream 1 pipeline need to be serviced, and they are missing key components like turbines, and for example, so they have to shut it down. It was supposed to be on stream again last Saturday, but last Friday, the G7 came out with another resolution, said they are going to put a price cap on Russian gas and oil. So that makes the Russian very angry, and now they said, look, I'm not going to turn on the pipeline. So now they are not supplying natural gas through this pipeline. Of course, there are other pipelines that supply natural gas to the various part of Europe, but in terms of the quantity itself is so much reduced. It means if the supply got cut down and demand remain constant, price is only one way to go, and you can guess which way it is. Okay, so what are the impacts? Germany is the industrial engine of Europe. If Germany fails, the rest of Eurozone will fail, and that will have knock-on implication for the rest of the world. We are already seeing high energy prices resulting in German companies and industry shutting down operation because they simply cannot afford the energy that they are paying for. Okay, so basically we are seeing German firms starting to shut down. If the industrial production of Germany shut down for extended period of time, the whole of Europe is going to go under. Okay, so that will only means the euro will come under even more pressure to ease off. Okay, so we are seeing the fundamental here that is definitely not in favor of the euro. Okay, and it's not just the euro. Across the world, we're seeing all major currencies having to decline. Now let's talk about the other elephant in the room. The other elephant in the room we are referring to is, of course, the Japanese economy. Now, the Japanese economy is a zombie economy for more than 3 decades. Okay, ever since they signed on to the Plaza Accord, they have never quite recovered, and they have accumulated so much such a huge mountain of debt. But the one thing good about the Japanese is that they did not go out and borrow. Unlike the United States, they actually depend on foreigner buying their treasuries. The Japanese, because the Japanese are ardent saver, they have been borrowing from within their savings account, from their savers, for within Japan itself to fund their government debts. But it is huge. One of the, in fact, the largest amount of sovereign debt the world has ever seen. Okay, so Japan also cannot afford higher interest rate. An increase in interest rates means the interest to service this debt become unbearable. So the Japanese government, or rather the Bank of Japan, has been saying something called the yield curve control. They are trying to put a lid on JGBs, which is the Japanese government bonds, to an unrealistic 0.25%. It means it cannot go beyond 0.25. Okay, in terms of the yield for the 10 years JGBs, and this is going to be a losing battle because these are market forces. And we can see the Japanese yen is the worst performing currency this year. It has gone down by more than 25% at one stage. So we can see that the Japanese currency is under attack. And given the choice of defending the yield curve, the Japanese government has decided to sacrifice the yen. So you can see the dollar yen has been going up. It means to say the yen has actually fallen. Okay, but as of the last 24 hours, we can see that the BOJ has actually come out and test the market. And when the BOJ is checking rates, it means this is a prelude to a possible intervention. When the BOJ actually intervene in the foreign exchange market, what they do, they will sell dollars, they buy yen. Okay, so dollar yen came to as close as you can get to 145. Okay, and it has stuck there. And over the last few days, you can see dollar yen come off a little bit because speculators are very concerned if the BOJ comes in to intervene it will be quite a big move. Okay, tends to be very, very big move. I myself have lived through a few BOJ intervention, and it can be very traumatic. Okay, if the whole world is long, imagine all players are long dollars and short the yen. If the BOJ came in to intervene, they have to unwind this position in a very short span of time, and that will cause a fracture in the marketplace. Okay, so this yield curve control, as of this afternoon, the yield curve, you can say they are trying to put the yield curve for the 10 years JGB at 0.25. 0.25 is actually an artificial ceiling. You can see that this, as of this afternoon, is already above at 0.26. But you can see that they have, intermittently they have gone many times they have gone beyond the 0.25, but it has more or less capped at a 0.25 cap. But this is a losing battle. It is very difficult to maintain an artificial cap when the demand is so strong. Okay, so let's see whether this cap is going to be relaxed at any time soon. Now, when we look at the currency market, this is what we are seeing. Across the board, all major currencies, and especially emerging market currencies, okay, we can see only one word, okay, which is strong dollar. The dollar is so strong, it's sucking all the capital from around the world. Euro versus the dollar. For anybody who have traded foreign exchange, you know there are two currencies that are being quoted. The one on the left is called the base currency. That means to say it is one unit. If we're talking about euro versus the dollar, the euro is 1. How many US dollars do you need to exchange for 1 euro? If the rates becomes lower and lower, it means the euro is going down and the dollar is getting higher. Okay, so when you see a chart like this, in the euro dollar chart like this, it means the euro is falling relative to the dollar. Okay, we can see that the market has actually gone slightly below parity, but like I said, parity is not the bottom here. Okay, it has gone even lower than that. Now, the same also happens for the sterling versus the dollar. Sterling has been a worse off currency compared to euro. Okay, for that matter, if you go back and check the inflation rate, the CPI numbers, the UK, after leaving Europe, now is under a very different place right now. Inflation is basically running away. At one stage, it was 10.1%. 10.1% is actually a 40 years high. Okay, and of course, this week we saw the CPI numbers come off to 9.9. But still, there is going to be a lot of pressure on the sterling because banks like Citibank and Morgan has actually says that going forward, the CPI numbers in the UK is likely to hit 22%. Now, can you imagine 22% inflation rate? Okay, the BRICS are totally alien to this kind of rates. So going forward, it will mean they will have to continue to hike interest rates to match the US rate hikes. Okay, but again, comparing the two, we know that the US dollars is going to be even more superior. They're going to suck up more capital compared to the UK because the UK fundamentals are actually quite poor. Okay, so for the year itself, up to this afternoon, we can see that the sterling is down almost 15% against the dollar, whereas the euro is down one stage of 13%. Okay, so that's also true for the other major currencies like dollar versus the CAD. Now here the dollar is the base currency, means $1. How many Canadian dollars do you exchange for the 1 US dollars? It means if the chart shows prices are going up, it is the dollar that is strong relative to the Canadian dollars. Okay, likewise for dollar yen is the same thing. Now for dollar CAD, it does not have a wide range of movements because it is, after all, as the dollar goes up and if the crude oil prices goes up, Canadian is a major oil exporter to the United States at one stage. Okay, so it is very closely correlated to the price of let's say crude oil. Okay, so if crude oil price stay elevated, okay, the two will balance out. On the one hand, you have strong dollar, but again on the other hand, we have strong crude oil prices. It will mitigate the decline in the Canadian dollars. So that more or less even out. So visually, we can say that the money is not in dollar CAD. If you're going to trade FX, dollar CAD year to date as of this afternoon is up only 4%. Compared to this dollar yen, for example, dollar yen is like 25%. So if you have to trade, you want to find the one with the widest range. Okay, you have a lot of choices. You can either trade the sterling versus the dollar, the euro versus the dollar, or the dollar versus the yen. Okay, now the dollar has actually appreciated 25% against the yen, and we are not even done for the year yet. So likely we are going to see even higher prices going forward. Okay, So how are you going to take advantage of all this movement in foreign exchange market? Now, 24 hours is the one key element of a foreign exchange market. It used to be traded over the counter. I remember when I first traded FX products, that was back in 92 when I joined StanChart. Now, those days, it was very exclusive. Only the private banks customers are able to get access to foreign exchange products, okay, even on a leverage basis. These days, people like you and me, okay, with very little capital can also partake in the trading of currencies. Currency has always been one of the most popular asset classes, okay, and that means if you can get a hand in participating in the foreign exchange market, now there is a lot of opportunity opens, okay, regardless of what happened in the economy or what happened in the geopolitics, exchange rate will continue to move unless we go into a situation in which we have fixed exchange rate. Pre-1971, exchange rates are fixed to the price of gold. So basically, and the rest of the other major currencies are pegged to the dollar. The dollar is pegged to the gold market. So basically, it's a fixed exchange rate regime. So there is hardly any movement in foreign exchange. But since the US has actually unilaterally abandoned the gold standard, foreign exchange market becomes floating market. So it begins to fluctuate. So this will continue going into the future unless the world decided that they want something more stable, they want to fix exchange rate again. But until then, foreign exchange is actually one of the key. Now, you don't have to monitor all exchange rate, only monitor the one with deep liquidity, okay? And what will give you the deep liquidity in the foreign exchange market? The number one is, of course, the euro versus the dollar. The dollar is the single most transacted currency. But in the foreign exchange market, you cannot have one currency. You need to have two, okay? It's like a seesaw. One goes up, the other one must go down. The other one go up, dollar must come down. So basically, it's a seesaw. A fight between these two is always a relative value, okay? So in foreign exchange market, there are always two currency, the base currency and the quoted currency. So when you trade euro versus the dollar, you must understand the currency that's quoted on the left is the base currency, the one on the right is the quoted currency. So for euro versus the dollar is the most liquid of all currency pairs. Okay, so you can see that the CME actually launched a micro FX futures. When I was trading FX currency futures, and we had to do a mental somersault because in those days the CME do not offer what we call FX futures. They have currency futures, which is a reciprocal. That means it doesn't need two currencies. Basically, the way they quote it is 1 divided by whatever the spot rate is quoting. So you get a very alien kind of numbers, 0 point something, okay? And those were the currency futures of old. They still have it, but by and large, people are more in tune with the spot market relative to FX market. Okay, so when you trade the CME mini micro FX futures, is as good as trading the spot market because they are quoted the conventional way, like what you see in the interbank markets. Okay, so these products here are actually geared for accessibility. The entry to barrier is actually very low. You can see the margin requirement is actually very affordable. You and I can all afford to put down a margin of a few $100 US to take one contract of the micro FX futures. Now they are all in different contract specification. This is a table that summarizes everything. For euro versus the dollar, the symbol used in CME is actually M6E. Okay, M for micro, 6, okay, is the number they decided they want to use for the micro FX futures. E is the euro. Okay, stands for euro, and the contract size is 12,500 euro, and it's quoted in 4 decimal point. The last decimal point movement is equal to $1.25 US. Okay, so that margin is $265 as of now. Okay, then of course the various contract size are very different for the other currencies. We have sterling pound quoted as 6,250 pounds, and the 4th digit in terms of decimal point is quoted as 0.625 cents. Okay, so again, you have to understand that they are quoted in different currencies. Euro and sterling are quoted in dollars. Aussie is quoted in Aussie, okay, equal to $1, as well as the euro and sterling as well is concerned. Now, the one will start to get different will be from dollar yen onwards. Dollar yen is quoted as a $10,000 contract size, but they are quoted in 2 decimal point. Okay, 2 decimal point. The 1 point move is equivalent to 100 yen. Now, 100 yen, if you minus off the 2 zeros of the 100 yen, is 1 yen. Okay, but you say to make it easy for you, 100 yen. When I travel to Japan, okay, I make it simple for myself. I say, okay, 100 yen is equal to $1 US, but actually it's not. Okay, because the dollar now has actually gone up to 145. So it definitely costs a lot more yen to buy the same dollar. So in this case, the 0.1 point move in dollar yen is equal to 100 yen, which you have to convert back to US dollars if you want to do the conversion. Okay, what you do is you times by the exit rate that you have one buy, you have one sell, whatever the sell rate is, you just do it against that rate that you exit. Okay, so the margin requirement is 37,800 yen. To make it simple again, it's about $300. Okay. Now, dollar Swiss is not very widely traded. Okay, later on when you see the chart, you'll realize why dollar Swiss is not very actively traded. This one is also the same, $10,000, one contract size, and it moved by 4 decimal point. One last decimal point move is equal to 1 Swiss francs. And again, when you want to convert back into dollar, you have to do it against the exit rate. That one is 350 Swiss francs. Then of course we have dollar CAC. Dollar CAC, again, $10,000 per contract. 4 decimal point move is 1 Canadian dollars. That one is the cheapest at $170 per micro contract. Now, this is just the basic. You have to understand it because when you come to calculating the P&L, you need to know what is the value of the one pip itself. Okay. Now, this is a chart of the various micro FX futures quoted by CME. Now, this contract actually expires on the 3rd Wednesday of the calendar month. Okay, and that means yesterday onwards is a calculation. So we are seeing a bit of a rollover into the next contract month. The contract is quoted every quarterly. We have March, June, September, December. September, if you do not have a position, do not go into September. You want to trade the December contract because we are seeing the rollover into December as of yesterday. Okay, so yesterday we can see that the rollover has actually started, and you can see this is the daily time frame. The market for euro versus dollar has been only one track. Occasionally the market will bounce, but every bounce is getting lower and lower compared to the previous high. Okay, likewise the low is getting lower and lower compared to the previous low. So this is a classic definition of a downtrend. This market downtrend is as clear as daylight. Okay, so going forward, if you've got a view at the current price, is it still worth your time and your money to take the risk in selling the euro versus the dollar? On an intraday basis, it may be quite different. What I'm seeing here is that the dollar is about to enter into a corrective move. That means if you are going to trade counter trend, I think the prospect of success is a lot higher if you're trading a lower time frame. So over the next few days, we are only left with one more day before the weekend is over. Next week, like I said, the key next week is to look out for the FOMC, which is on Wednesday morning at 2 a.m. our time. Okay, and before that date itself, the market will drift, and I think there will be some kind of profit taking, and it's just about time to trade counter trend going into the FOMC meeting. Okay, what happens after the FOMC? The market can resume its original trend, which is down. Okay, it means to say that the dollar will continue to charge higher. Maybe, okay, depending on what is the actual result. Is it going to be a 0.75 increase, or is it going to be a 1 full percentage point increase? Okay, so we will have to watch. So going from there, just purely looking at the technical outlook, we can see that the market is already very near a key level. This key level is at 0.96. Where we are right now, we are just barely above parity. This afternoon, when I update my chart, the market is at 1.0035 relative to the December contract. Okay, so the December contract right now is just above parity, and if the market actually bounce, okay, there is a good prospect that the market may actually bounce to challenge 104. Okay, the maximum, or rather the most optimistic outlook is 104. Thereabout, I think the market will resume its downtrend, and when that happens, I think the market will eventually start to move towards the 2002 low, which is 0.96. This is not the ultimate low, but it is an intermediate stop. Okay, so it doesn't mean that the market is at parity. It means this is the bottom. It is not the bottom. It has come here before. It will continue to go to challenge previous parameters. Okay, so over the last 3 days, today is Thursday. Over the last 3 trading days, you can see that this is the average trading range, and to tell you whether this market is tradable or not. Okay, on the average, we have Monday we have Monday we have 139 pips, and then on Tuesday we have 221 pips, and then this of course is the CPI number released. The market was quite volatile, and yesterday the market actually slowed down a little bit. It was only 68 pips. So on average for the last 3 trading days, we have 143 pips per day, and that translates, if you times by the value per tick at $1.25 US for euro versus the dollar, it is a trading range. Every one lot is about $178, which is quite respectable. Okay, considering the margin requirement is only 375, so it is almost half, okay, of the margin that you put up, with the potential to make it back that much on a single micro contract. So in terms of the trading range is very, very wide. Okay, it allows you to actually do scalping on an intraday basis, especially so if the commission that you pay is very competitive. These days, we all understand commission has actually compressed to the point where it actually pays to be the trader rather than to be the broker. I used to be the broker. Now I'm on the other side of the fence, and that's one of the reasons why I come out and trade full time, because it has become very, very competitively priced. Okay, and if the spread between the bid and offers is very, very tight, which is the case right now, okay, then it makes even more sense, because if the spread is so tight, this afternoon I saw only a one pip difference between the bid and offer, the bare minimum. Okay, so it means that if the spread between the bid offer is tight, the commission is low, it does make sense to scalp the market on an intraday basis. Very tradable by just looking at the daily trading range. Okay, now this is the sterling versus the dollar. Same thing like what you see in the euro versus the dollar. The trend is almost similar. Okay, and the low traded this round last week was 1.14. okay, the market went out to 1.14, which actually challenges the March 2020 low. The March 2020 low, if you cannot remember, was the start of that market move across all asset classes. The stock market actually bottoms out of March 2020, and then it never quite looked back since. Okay, same thing going into the pandemic. When the WHO actually declared COVID-19 as a pandemic, the market went berserk. Okay, we have the fastest, most aggressive stock market crash in recent memories. Okay, all happens within the period of 4 to 5 weeks, and then you rebound and go back to new high. Likewise, currency market also reacted, very differently, but basically the fundamentals are the same. Okay, so you can see that sterling right now is back to that same level. Okay, it has already erased all its gain since the start of the pandemic. Now it's scraping the bottom of the barrel again. Okay, is this the lowest? No, it's by no means the lowest. Can it go lower? Of course it can. Okay, so again, if you've got a view, you can actually take this view and trade this particular contract, which is very, very accessible. Over the last 3 trading days, you can see that on the average, it has even a wider range compared to the euro versus the dollar. On average, about 157 pips. Okay, and then when you times by 0.625, you get about almost $100 point range. Okay, so it is still very, very, very tradable. Now, Aussie versus the dollar. Now, the Aussie versus the dollar has a different pattern altogether. Yeah, but by and large, it is also a downtrend as far as the daily time frame is concerned. Okay, the high traded was 0.7669, all the way down to 0.6687, and the market is again coming back to those levels. When did we see the bottom? The bottom was actually registered in July this year, which is not too far away, which is only about 2 months ago. Okay, so now the market is coming back to those levels, and will it break? I think it will. The only thing that will hold the market up is basically Australia is a commodity export economy, so they are very dependent on commodity prices. If commodity prices stay elevated, which they will, then of course that will mitigate the seriousness of this move downwards. Okay, so when you trade Aussie dollars, you got to know what are the factors that influence the Aussie rate. Okay, same thing, the the Reserve Bank of Australia has been hiking interest rates of late, and they're also way behind the curve, and they are catching up. And that means as much as they hike, while there is going to be demand for Aussie dollars, but by and large, you can see that they cannot withstand the attractiveness of the US dollar. More demand for US dollar eventually. Okay, so again, this is a market. Once it breaks 0.6687, it's starting to test lower. My target for this round is 0.6444. Okay, now you can see this is also very tradable. On the average, this week itself about 107 pips, which equates to $107. $1 equal to 1 Aussie. Okay. So dollar yen is quite unique. Okay, of course, the movement in dollar yen has been very exaggerated. Remember, the dollar yen has gone up almost 25% this year alone. Okay, and the movement, most of the players are in the dollar versus the yen trade because they know the BOJ is not going to do anything on interest rates. So it's very, very safe to sell the yen and to buy the dollar. Okay, so this trade is one of every FX trader's favorite, because on one hand you have a Federal Reserve that is very, very clear what they want to do. They want to continue to hike rates. Okay, and on the other hand we have the BOJ that is really scared of hiking rates and putting a cap on the bond yield. They are not going to do anything and allow the yen to collapse. Okay, which is what's happening right now. So the high traded was almost in the cash market was 144.99. almost 149, but it did not quite make it up there. The high traded in the micro December contract was 144.76, and now it's coming back down. And this is because the market is worried that the BOJ can come in anytime now to intervene. So the market has having come kind of pullback. So over the last 3 trading days, on the average, it's about 200 pips move. 200 pips is exaggerated, meaning to say that again, when you do dollar yen, you must understand the P&L will be in yen. Okay, what the minimum pip movement is 0.01 pip, and the 0.01 means 100 yen. 100 yen, you got to convert it back into the dollars. You got to do it against the exit rate. Now, assuming your exit rate is 142.31, this is about the price of the dollar value, $141.03 for on the average. Okay, for intraday, it is definitely enough range for you to do intraday. So it's one of the most attractive currency pair you can trade. But remember, the P&L is in yen, and if the yen is falling, your profit will be much reduced in that sense. Okay, because the yen is falling, so your P&L is in yen. Your P&L, yeah, on the one hand, your profit may not look as great when you convert back to the dollar. Likewise, your losses will not be as bad. Okay, if you're on the wrong side. Okay, the market is fast approaching the 1998 high, which is 147.47. Basis the cash index. Okay, dollar Swiss, you can see that there's a lot of gaps in between. So for the time being, okay, if you can avoid trading dollar Swiss, maybe you should, because looking at the chart, you can see that there are too many price gaps. There are days in which there is simply one pip move, and there are many. Those gaps that you are seeing, okay, this means that there's hardly any price movement, only one price, which is the settlement price. Okay, so for the time being, if you can totally avoid trading this pair, do so, because Euro versus 3 is one of the less traded currency pair. Although they are major currency pair, but they are one of the not so actively traded. Okay, so that can be seen in this product itself here. Okay, the other one is also the same, which is dollar CAC, slightly better. Compared to dollar Swiss, you can see that there are still gaps. Okay, again, when you have gaps, it means it increase your risk overall. One of the things that we have to consider as trader is not only the cost of the commission that you pay, it is the spread. Okay, if the market is not liquid, that means the bid offer spread is wide. Every time you are in a hurry to get in or get out, you have to sacrifice the spread altogether, and that will add to your trading cost, which may not be viable over a longer period of time. Okay, so if you can avoid this market that has a lot of gaps in between, try not to trade those markets. Although the trading range is decent. Okay, on the average about 60 pips per day. Okay, so if you need more information, here there is a link at the bottom of this slide here. I will give you the entire presentation slide, and it's up to you to request for a copy from Phillip, and I'm sure they will be more than happy to give it to you. Now, there's a lot of, why am I going so fast? There's a lot of information at the at the CME website itself, a ton of resources. Whether you need opinion, you need to know more about the fundamentals, the technical outlook for the various currency pair, you can find it here. And there are commentaries by analysts, which is also posted on this on the website itself. So the link is over here, okay, from CME. Now I will take questions. I know I have overstretched